Good morning, everyone. Here we go again. Today we have our 18th set of paper for LCCI Level 3 Financial Accounting, April year 2018. Okay, again, 100 marks, 5 compulsory questions. Let's start. Okay, we have how many items? 1, 2, 3, 4, 5, 6, 7 items. Oops. Okay, and then of course it is extended trial balance. Okay, we have to calculate. Okay, let me update this first. Extended trial balance. Work on some questions and then the extended trial balance. Okay, 22 marks. Let's take a look. State one reason why a business may open a suspense account. Okay, it is because the total of the debit side is not equal to the total of a credit side in the trial balance. Okay, and this suspense will hold the balance before you can locate and correct all the errors. Okay, so explain with reference to an accounting concept one reason why a business may create an allowance for doubtful debt. Okay, of course the most obvious answer is the prudence concept. Okay, but the accruals concept also applies to the case, okay, to the creation of allowance for doubtful debt. Okay, the explanation of course is that okay, it is possible, okay, from previous years. Okay, we know that from historical data, we know that our debtors, okay, not all our debtors will repay our debts. Okay, and then we have to prepare for this loss, okay, because it belongs to the current year, not next year. Okay, so it possible irrecoverable debt. Okay, that happened in from sales in the current year. Okay, so if there is a possible loss, you have to prepare for it. Okay, that is the reason why we have the allowance for doubtful debt. Okay. Calculate the value of inventory. Okay, and also calculate the change in the allowance for doubtful debt. Okay, we'll deal with it when we have those information. So first item, on the 2nd of February, goods 650 sent and invoiced on a sale or return basis on 28th of January were returned. Okay, so goods were returned. Okay, this one, okay, is not stated clearly that by the end of the year we do not know and we haven't counted. Yes, okay, not accounted for. Okay, so these are goods sent on sale or return basis 650. It should be our inventory. Okay, added to inventory 650. Let me see. Okay, but then later we have to look at the markup because this is the invoice amount. Okay, so we will wait for it. Okay, on the 4th of February, goods of 400 were sold. Okay, so this is not related to our current year. Okay, our current year is year 2008, 31st of of January. Okay, and on the 5th, Marie, that is the owner, value her inventory at 2230. Well, then that's important, okay, because okay, when we count our inventory, this is already sold. Interesting. Okay, so Marie sells her goods at a markup of 25%. Okay, nothing else is related to the inventory, is it? Okay. If that is the case, then I think there is something wrong with the mark scheme. Okay, because if you look at this, okay, we count our inventory on the 5th of February. Okay, that means when we count the goods are returned, goods are already returned, then we should have counted. Okay, then this 650 should have no effect. Okay, should have no effect. Okay, because sent were returned. Okay, returned to you, then you have counted. Okay, then there should be no effect on inventory. Okay, but then in the mark scheme, okay, it says 22300, of course. Okay, and then we have to add back this 400. Okay, but then it is divided by 1.25 because we have to reduce it back to cost. Okay, and then we have to deduct the amount of 650 divided by 1.25. Why do we have to deduct? Why? The goods are returned to us. Okay, so it is good that we have counted it. Okay, and one more thing, why do we have to deduct? Okay, why minus? Okay, anyway, I won't use this because I think it is incorrect. So let us keep to the correct one, just to tell you okay, there is such a thing, okay, of deducting 520. Okay, I don't understand. 22300 400 divided by 1.25. 22300 plus 320. I can just say if they want to deduct it, that means at the end of the year you have not counted it as well. Anyway, okay, I'll keep this answer 22300 320 22620. Okay, this is my answer. Okay, it might not be equal to, it might not be the same with the mark scheme. Okay, but then I still keep on to use the correct answer instead of what is given. Okay, if both are okay, okay, I will explain the reason for both. Okay, but then if I think it is incorrect, then I'll keep to the correct one. Okay, so inventory done. Okay, one more thing, because I think if we have mistakenly put the invoice the sales, okay, it is also important for you to deduct the amount of sales here, 650. Okay, so let us see. It is not mentioned, right? Okay, and had not been accounted for. Goods returns, and it is invoiced, sent and invoiced on a sale or return basis. Okay, and you are not told, okay, how it has been dealt with. Okay, then I think we have to deduct the amount here as well. Okay, but anyway, sales returns. Okay. And in the mark scheme, it put in the sales returns as well, but not sales. Okay, but then if it is goods sent on a sale or return basis, why in the first place put it in sales? Okay, you have to deduct the amount. Okay, it's not sales yet, and goods are returned. Okay, it is fundamentally wrong. Okay, the mark scheme. Okay, I am angry now. Okay, because of the sales returns thing. Okay, anyway, I hope, okay, the other items will be better. Okay, let us start from item 5. I am so angry. Okay. Anyway, telephone expenses included rental of 360 for 3 months ending 28th of February. Okay, that is 1 month prepayment. So 1 month is 120 prepayment. Okay, this is rental. Sorry, what? Okay, telephone expenses included 360 for rent. Okay, so telephone expenses should not be in rent. Okay, and it is also 120 prepayment, and telephone call charges 165 owed. Okay, I am so tired now. Okay, so let's deal with the rental income first. Okay, where is rental income? Rental. There is no rental. What is happening? Why telephone expense? Okay, so if we do not have rental, okay, telephone rental, is it? Okay. It is telephone rental, okay, not telephone expenses. Okay, so we have prepayment, so 120, then 120 here. Okay, prepayment, and then we have 165 owed. Okay, so 165 other payables, and then 165 here. Okay. Item 6. General expenses included a payment for new computer 1890 for personal use. Okay, so this first question is difficult. Okay, I hope you will never have to face these things, because one error, I mean one item, they have multiple things. Okay, general expenses 1980. Okay, for personal use. New computer. Okay, anyway, it won't be computer, it will just be drawings. Rent and general expenses, right? One general expenses is debit. If we want to reduce the amount, then it is crediting 1980, and then it goes to the drawings account 1890. Okay, and then we have 5% allowance for doubtful debt for trade receivables. Okay, let's see, trade receivable 16810. Okay, minus 650. Now we have 16160, and then 5%. Okay, we have 808. Okay, let us go back. Okay, 808 minus 580. We have 228 addition. Okay, so allowance for doubtful debt is in the credit side, so 228 here. Okay, let me use another color. 228 here, and then allowance for doubtful debt adjustment 228 here. Okay, we finish. Okay, so my my answer, okay, if compared to the mark scheme, okay, there will be a difference of 2 marks. Okay, for this 2 marks, I am willing to pay in defending what is right. Okay, 1 mark is here. Okay, the calculation of value of inventory. It says 3 here, but then it consists of a few things. Okay, I skip one component, that is 1 mark, and then the second mark would be here, the revenue and sales returns thing. Okay, anyway, I am willing to give up this amount, okay, for what I think is correct. So question 2. What is that? Okay, we have some adjustments. Okay, is it correction of error? Rec. Okay, so errors. Okay, correction of errors. Are we working on the correct set of paper? Yes. Okay, why is it so strange? Okay, anyway. Okay, we have these errors. Okay, and show a gross profit of 56400 and a net profit of 9,200, and then we have to update, okay, the balance. Okay, state 2 advantages of a business being a sole trader. Okay, can keep all profit, can have full control. Okay, flexibility. Okay, so what we have to do is 11 marks. Okay, and we have to show the revised gross profit and net profit. Okay, and then state the accounting concept that applies in adjustment 5. Okay, so to have this, okay, it is important that you understand the corrections to be made. Okay, so I will write down the journal entries, okay, so that it will be clearer. Okay, item 1, the total sales day book had been understated. Okay, this is quite easy. Okay, total sales day, total of the sales day book. Okay, that would be debit, trade receivables, ledger control, credit, sales. Okay, so sales, it affect both gross profit and net profit. Okay, because it is in the trading section. Okay, that's why, okay, when you look at the answer given to you for item 1, it will be added for both. Okay, it is in the credit side sales. Okay, so item 2, carriage out 650 had been treated as carriage in. Okay, so carriage out is an expense, carriage in is no gross profit. Okay, but then they are both cost and expense, so there will be no change in the net profit, but then there will be a change in the gross profit. Okay, so carriage out treated as carriage in. Okay, so carriage in, okay, and then you put it back to carriage out 650. Okay, there will be no effect on net profit, but then we have effect on gross profit. Okay, you can see which one is carriage in? Carriage out treated as carriage in, so here. Okay, carriage in, you should credit. Okay, so here that means you have gross profit increased. Okay, so 650, no change. Next, item 3. An irrecoverable debt 260 have been treated as an what? An irrecoverable debt recovered 260 treated as an irrecoverable debt. Okay, so item 3. Okay, so it is an irrecoverable debt recovered. Okay, so we'll put suspense here. Okay, and then take away irrecoverable debt. Okay, take it away 260, and then put back irrecoverable debt recovered. Okay, and then 520 here. Okay, so you can see it will not affect gross profit. Okay, because it is not in the trading account, but then we will have net profit affected 260 credit, that is 520 addition. Addition. Okay, next one. Item 4. Returns in 300 had been treated as returns out. Okay, item 4. Returns in is correct, but then treated as returns out. Okay, so let us put back returns in. Returns in is in the debit side, so we have 300. Okay, and then returns out, okay, we put it in the credit side, and then when we want to take away this error, we debit it. Okay, so it is kind of like what we are doing for extended trial balance. Okay, so credit, suspense again 600. Okay, so returns in, returns out, they are both in the trading section. Okay, and then here we have debiting. That means gross profit will be affected negative, and net profit will also be affected negative. Okay, 600 minus for both. Okay, usually I will use bracket, but then because I see from the example it gives a plus sign, so I will follow. Item 5. Green. Goods taken for personal use 180 cost price have been treated as a general expense. So take away from general expense 180, right? 180. Okay, and then put it in drawings. Okay, so you can see drawings is not related, but then general expenses is. Okay, so there will be no effect on gross profit, not in the trading section, but then net profit will be increase. Okay, so 180, no effect on gross profit. The accounting concept that apply in adjustment 5, okay, if it is for private use, okay, then we should put it in the drawings. Okay, so this is business entity concept. Okay, last item, item 6. Item 6. The machinery costing 8400 was purchased on the 1st of April. The business depreciation policy is to apply 20% reducing balance method to the machinery, but the straight line method of depreciation was applied. Okay, so what is our year end? Okay, our year end, okay, it is 1st of April 16 to 31st March 17. Okay, and then this is our second year. 31st March 18. Okay. Okay. Let us calculate. Okay. For it is our second year. Okay, so we have to see. Okay, if we use straight line, if we use reducing balance. Okay, just now I am a bit worried. Okay, because how about the first year? Is it applied wrongly in the first year? But then I discovered that it doesn't matter because it is the second year. Okay, that's good. Okay, it takes away this this doubt. Okay, so 20% straight line, 20% reducing. Okay, in the first year it will be the same. 8,400, 20%, 1680. Okay, so if depreciation is applied wrongly, okay, it doesn't matter whether it is from the first year or just starting in the current year. Okay, because for the first year it will be the same. Okay, so straight line it will be the same, but then reducing balance, okay, we will have a lower amount, 1344. Okay, so what is the difference? Okay, the difference will be 336. Okay, depreciation is overstated by 336, so we have to reduce the amount of depreciation. Okay, reduce depreciation, we have depreciation expense here, and then allowance for depreciation here, 336. Okay, so here, credit. Okay, because we have charged more depreciation than needed, not related to gross profit. Okay, but then it will add to net profit, 336. Okay, so we have finished now. Okay, we will calculate the total. Okay, 5, 6, is it 100? Let me see, item 5. general expenses. Oh, one thing. It is treated as a general expenses. Okay, we have to do one more thing. Let me see. Okay, here there is something wrong, okay, with what I have written, and I am thinking about it. Okay, so again, let us take a look. Goods taken for personal use 180 have been treated as a general expenses. So it has been treated as a general expenses, then it will be the original entry, okay, will be to debit general expenses and then credit purchases, I think. Okay, it is not possible to have drawings and then general expenses. Okay, we take away goods, so we reduce purchases and then put in general expenses. Then that means, okay, it goes like this. Okay, this is the original entry made. So again, I stand by my answer, okay, because it is treated as a general expenses. That means it is not put in drawings, rather than it is not put in purchases account. Okay. Okay. So if that is the case, okay, the answer is like that. So 56650, although it is not the same as the answer key. Okay, again, I think they are being careless in working on the paper. Okay, too many problems with this paper. Okay, anyway, okay, you can decide which to follow. Okay, but then you won't see another question that will be the same. So I advise you to learn the correct way to do it. Okay, so state one reason why Jeremy should prepare a bank reconciliation statement. So bank reconciliation statement is to explain the difference. Okay, because usually it will be different from your record. Okay, the bank statement will be different from your own record. Okay, and then if you just put it there, okay, it doesn't matter. Okay, it's normal. Then you don't explain the difference. You don't prepare the bank reconciliation. It is possible that there is really a fraud. Okay, and then you don't know because you think it is normal. Okay. State two adjustment in the cash book balance that Jeremy must make before preparing a bank reconciliation statement. Okay, so it can be bank interest, okay, bank charges. Okay, but then I won't give these as two. Okay, I might say this dishonored check. Okay, because bank interest, bank charges, they are of the same type. Okay, so usually I give my answers in a more diverse manner. Okay, so state 2 reasons why it is important for a business to measure its performance. Okay, of course, okay, to make decisions, can I say? Make decisions for the future, for future operations. Okay, and then to compare to other businesses, okay, or compare to the previous years. Okay, I will exchange these two. Okay, because through comparison we have a conclusion, and then we make decision. Okay, usually it is like that. 19 months. I am very unhappy with this paper. Okay, anyway, we will continue for partnership. A, B, and C were in partnership, sharing profit and losses in a ratio of 3 to 2 to 1. The partnership agreement provided for interest on capital, 5% on opening balances, and then B to receive an annual salary of 8,000. Okay, on the 1st of February, we have the following. And then at the end of the year, I think, is it? 1st of February being the start, yes, then 31st January will be 1 year afterwards. Okay, B decided to leave the partnership. A and C were to remain in partnership, sharing profit and losses in a ratio of 2 to 1. And then non-current asset revalued with a loss on revaluation of 9,000. Goodwill valued at 18,000, not to be retained in the books of accounts. B's account was settled by a check and then the balance as a loan. For the year ended 31st January, the profit for the year was 74,000 before any appropriations. Of course, profit, right? Partners took drawings of 15,000 each. Okay, so we have to prepare journal entries to account for goodwill. Okay, good. And then current account of B, capital account of B, and then discussion question. Okay. So 18,000 goodwill. Okay, so first of all, we have the creation of goodwill, debit goodwill, and then credit capital of A, B, and C. Okay, I do not want to write the names. Okay, just let it be. Okay, so 18,000, 3 to 2 to 1, that is 6 divided by 6. 3 to 2 to 1, right? Or 1 to 2 to 3. 3 to 2 to 1. Okay, that is 3,000, 6,000, and then 9,000. Okay, narrative not required. Okay, so we immediately write it off after B leaving. Okay, so capital of A and C, and then goodwill. Credit 18,000. Okay, now it is 2 to 1. 18,000, 2 to 1, that is 12,000 and 6,000. Okay, finished. 2 marks only. Okay, so current account, and then capital account. B. Okay, debit balance of 18,000. We have 8,000 and then 5%. Okay, 30,000, 5%, that is 1,500. Okay, we have to calculate the oh no, 3,000. Total interest on capital will be 6,000. Okay, if that is the case, 74,000. Okay, salary 8,000. This one 6,000. 6. We have 60. Okay, and then B would be able to get 20. Okay, 30 here, 10 here. Okay, so 1,800, year 2017, 1st of February. Okay, the balance 1,800. Year 2018, 1st of January. Okay, appropriations. We have salary, we have interest on capital, we have share of profit. Salary 8,000, interest on capital 1,500. Okay, and then 20,000 for the share of profit. Okay, and then drawings. $15,000 each. Okay, so let's take a look of how much is left. Okay, we have 12,700 left, and that is to be transferred to the capital account of B. $12,700. Okay, capital account. Year 2017, 1st of February, we have the balance of 30,000. Okay, just now we have 12700 from the current account, the 1st of January, current account. Okay, we have the goodwill adjustment. Goodwill adjustment, we have how much? 18,000 divided 6,000. Okay, so we still have one more thing. We have revaluation. I almost forgot. 9,000 revaluation loss, not gain. Loss on revaluation. Year 2018, the 1st of January. Okay, revaluation here. Okay, 9,000. Okay, so what is the final settlement? The final settlement being 15,000 by check, and then the rest for a loan. So 15,000, the 1st January, bank, and then loan from B. Let's see how much loan has to be given. Okay, that will be 30,700. Okay, so it's done. This time it is better. Okay, at least it is normal, no obvious mistake. And then the 5-mark question. Okay, discuss whether A and C should continue as a partnership or form a private limited company. Okay, so this part we have finished a lot of times already, so I am not going to work on it this time. Okay, because I'm too exhausted from question 1 and 2 and too angry. Okay, I'm not going to play by this question. Okay, anyway, go back to the last 2 exercises if you do not know the answer for this one. Okay, partnership or limited company. Okay, so we'll have a break, and then when we come back we will have this. This is sole trader, I think. Okay, not accounted for. We have a list of balances. Calculate trade receivables. Calculate a lot of different things. Okay, and then calculate the adjusted profit. Good. And then statement of financial position. So I will say it would be sole trader. Okay, and then question 5, that would be statement of cash flows 2 years, and then some information, and then yes. Okay, this is stakeholders for part A. Okay, and then reconciliation, and then statement of cash flows. Okay, evaluate working capital management over 2 years. Okay, that is cash equivalent, one thing. Okay, and then inventory, trade receivable, trade payables. Okay, so okay, we will come back in 10 minutes. Okay. Okay, so sorry that I take a longer time to calm myself. Okay, so let us continue with this single entry item. Kelly provided the following information. For the year ended 31st December. Okay, the year end 31st December year 2017, and opening balance given to you, equity, fixtures and fittings for cost and accumulated depreciation, and then trade receivables. Closing. Okay, we have bank credit balance. Okay, a bank loan, cash sales, a bank loan. Okay, cash sales. Okay, these are trial balance items. Cash sales, transfer to payables ledger. Okay, credit sales. Okay, discount allowed, discount received, drawings, inventory, other payables, other receivables, profit for the year are given to you already, and then receipts from credit customers, sales returns, trade payables. Okay. The following have not been accounted for. Okay, during the year, we have fixtures and fittings sold. Okay, costs. On 1st of January, year 2015, were sold. Depreciation is charged to all fixtures and fittings 10% using reducing balance method. Full year depreciation is charged in the year of acquisition, none in the year of disposal. Okay, that means for year 2005, okay, we should depreciate it for 1 year, and then during year 2007 it is sold already. So 1350 sold for 1350. Okay, there is a loss of 250. After the year, Kelly received an invoice for 1,800 for insurance covering 12 months ending 31st October. Okay, so that would be from the 1st of November year 2017 to 31st October year 2018. That is, okay, we will have 2 months accrual. Okay, then we'll have 18,000 divided by 12, and then 2 months. Okay, 300 accrual. Okay, what we have to do is calculate the trade receivables. Okay, calculate trade receivables. Okay, here we do not have anything related to trade receivables, so everything happens in here. Okay, opening trade receivables, and then we have cash sales not related, credit sales, and then transfer. Okay, transfer will be negative, and then discount allowed, receipt from credit customers, sales returns. Okay, so this is essentially the control account, but then we don't have to prepare the account. So let us calculate 34200 add 164680. This is the credit sales, and then deduct the 4 items. Let me calculate. 2440 154900 2180. Okay, it will be 160940 negative. Okay, that will be 37940. Okay, so I'm not going to repeat the calculation, so let us just put it here. 37940. Okay, calculate the carrying value of the asset sold. We have already calculated 1500 multiplied by 1 minus 10%, reducing balance method, 1350. Let me check again. None in the year of disposal. Ah, that is 2 years. Okay, not 1 year. Okay, let us recalculate. Okay, year 2015 for the first year, and then year 2016 for the second year. Okay, and then it is sold in year 2017. So 2 years depreciation. Okay, sorry for mixing up. Okay, so 2 square here. Okay, so 1500. That will be 1215. 1215. Disposal loss. It is sold for 1100 minus 1215. Okay, that is a disposal loss of 115. Depreciation charge for the year. Okay, carrying value at year end. Okay. The cost will be deducted by 1500. Okay, and then okay, minus 285. Yes, 285. Okay, so we have 6,000, and then 1935 minus 285, that is 1650. 4350 multiplied by 10%, that is 435. Okay, so 435. Okay, and then our carrying value will be 3915. Okay, so next we have to calculate the adjusted profit. Okay, there are I think 2 adjustments. Okay, one for disposal loss. Okay, and then another. Oh no, I think 3. Okay, one for disposal loss, for depreciation, and then for the accruals. Okay, so profit for the year 25095. Okay, disposal loss, how much? Disposal loss being 115. Yes, and then depreciation 435, and then the accrual 300. Okay, that means we have adjusted profit of 24245. Okay, so finish 4 marks for this one. Okay, so we have to prepare the statement of financial position. 6,000, and then here we have 1650 at 435, the new depreciation, that is 2085. Okay, and then that will give you a 3915 calculated already. Okay, so let me write all the stuff. Assets, non-current assets, we have fixtures and fittings. Okay, so current assets, we have inventory, trade and other receivables. Okay, I will write this separately. Trade receivables, other receivables, and then I will combine the two. Okay, so there is no cash and cash equivalent because we have negative. Total assets. Okay, so inventory, how much? 24200, other receivable 840, and then we look at the answer we have calculated for trade receivable, 37940, 37940. Okay, inventory 24200, 840 here. Okay, no adjustment for these two items. Okay, next item we have equity and liability. Okay, equity first. Any drawings? Yes, we have drawings. Okay, so opening equity 29530, drawings we have 21850. Okay, and then let us go to the equity part, I mean the profit, 24245. 24245. Next, drawings, closing. Opening balance 29530, drawings 21850. Okay, next we have liabilities. I remember we have a bank loan. Let us see. Yes, bank loan, year 2019, that is long term, 3,500. Okay, and then we will have trade and other payables. Okay, for other payables, we have an addition of 300. Okay, don't forget this. Okay, trade payables, other payables, and then we will have a bank overdraft. Okay, 2660. Okay, let us deal with the loan first. Bank loan 1,500, and then current liabilities. We have trade payables, other payables, and then we have trade and other payables, and then we have bank overdraft. Then we'll have total equity and liabilities. Okay, so that would be like this. Okay, trade payables. Trade payables would be 27230, and then other payables at 300, 1580. Okay, trade payables 27230, 1580. 28810. Bank overdraft, last item. Bank overdraft would be 2660. Let's see if we can balance it. 2660. 31470 added to long-term liability, added to total equity. Yes, 66895. Done. Yes. Okay, 18 marks for this one. Okay, not too difficult because you are guided on which items you need to work on. Okay, it can also be that you are not guided, you have to think. Okay, you have to adjust for depreciation, you have to find disposal loss, you have to adjust the net profit. Okay, you might have to think about all this by yourself. Okay, but then it guides you. Okay, so they are kind in this sense. Okay, 6 marks only for this part. Okay, so last question, of course, statement of cash flows. Okay, so first, explain one way in which the financial statement contribute to meeting the needs of, okay, that is the interest, okay, of these stakeholders. Okay, 2 marks each, that means you have to explain a little bit more. Okay, but then one way, okay, that means you have to drill deeper, okay, but not giving more points. Okay, so employees, okay, they want to know if the company is making good profits. Okay, look at the SOPLs, the statement of profit and loss. Okay, see if they have more profit, to see the job security, and also possible pay rise, okay, or bonuses. Okay, then that will be enough because you have pointed out which statement. Okay, provider of finance, Okay, most probably they are looking for the financial health of the company, so they will be looking at statement of financial position, okay, to see if they can repay the loan, okay, and interest, provide a return. Okay, so next we have to prepare the reconciliation and then the statement of cash flows. Okay, so let us begin. The directors of Cradle Limited have provided the following extract from the statement of financial position. Okay, year 2017, year end is in the left hand side. Okay, during the year, motor vehicle accumulated depreciation 15750 was sold for 20,000. Okay, motor vehicle, let us go and take a look. There were no acquisition or disposal of motor vehicle. Okay, and because of this, we can calculate the cost. Okay, 180,144, that is 36,000. Okay, accumulated depreciation 15750. Okay, that is, we can calculate this 15750. Okay, that is 15750. That is having a carrying value of 20250, sold for this, so you have a loss of 250. Okay, disposal loss, operating activities, okay, investing activities for proceeds. Okay, no other purchase or disposal, no other acquisition as well. That means the remaining item would be for depreciation, 87750 minus this one. Okay, and then the difference will be 36,000 again. Let me check again. 1057750 plus 36,000. Yes. Okay, depreciation. And then we have for plant and equipment. Okay, no purchase. Okay, so 68 minus 5. Okay, that is 17200. Okay, the two added together, you have depreciation of 53200. Operating activities and okay. No dividend paid. Okay, and then the loss for the year 28200. Loss for the year. Okay. So bank loan, we have borrowed more, financing positive. Okay, and then bank from an overdraft, okay, to positive balance. $13900 negative, 17650, 17850. Okay, we have an increase of 31750. Last three items of the statement of cash flows. Inventory, we have an increase. Let me use orange. Increase 4560, 8780. Trade receivables 18570. 18850. Okay. Whew. Here we have revaluation reserve, no change. Okay, that means the land and buildings and valuation here we have purchased 60,000 more. Okay, investing negative. Retained earnings, let us see if it is correct. We have a loss 28200 111500. Yes, it is correct. Okay, revaluation reserve. Okay, share capital we have 20,000 more and then 10,000 more here. Okay, that is an issue of shares. 30,000. Financing activities positive. Okay, so done. Okay, so the reconciliation. Net loss for the year. Okay, and then add depreciation, add disposal loss. Okay, net loss 28200 negative. Depreciation 53200. Disposal loss 250. 53450. Okay, so next part. We have increase or increase in inventory, in trade receivables, in trade payables. Okay, let's see. Inventory 8780. Trade receivable 18570. 18850. Okay, 18850. Inventory 8780. 18570. $8500 negative. Okay, this part in purple. Okay, we will also use it in the evaluation part. Okay, 25250. We have 16750. Net cash from operating activities. Okay, it is bad that we have a net loss, but then still we have a positive cash flow from operating activities. Okay, still not in the worst case. 16750. Okay, we will continue with A. Playing with the mic again. Go away. Shh. 16750. Net cash from okay, so we have proceeds 20,000 and then also purchase of non-current asset, okay, 60,000. Okay, no other purchases. 60,000. Okay, that is 40 here. Net cash used in investing. Okay, next, cash flows from financing. Okay, we have issue of shares, okay, and also increase in bank loan. Yeah, remember 30,000 here. How about bank loan? 25. Bank loan, yes, 25. Okay, and then let's see, 13900178850. Okay, 25. So we have 55 here. Net cash from financing activities. Last three items. Okay, we have 13900 for opening and then closing 17850. Okay, so we have 16750 minus 40,000 plus 55,000. 31750 minus 13900. Yes, correct. Okay, so this one is net increase in cash and cash equivalent. What is our year end? Okay, 1st of January, year 2017. 31st December, year 2017. Okay. So we finished this statement of cash flows, and the last part we are asked to evaluate the working capital management over the 2 years. Okay, so there are 3 items that we need to work on. First, these 3. Okay, inventory, trade receivable, trade payables. Okay, and we can see how well we manage them. Okay, inventory had increased. Okay, that might be because of the decrease in sales. Okay, and that we have made a loss, net loss for the year. Okay, so insufficient sales, okay, making you keep more inventory, okay, possible. Okay, but then you have more trade receivable. Okay, that would, and for that you can talk about two things. Okay, that is your inability to collect from your trade receivable. Okay, making it possible to have irrecoverable debt, and in turn affect your profitability. Okay, possible. Okay, you can mention. The second thing is, even though you are making an effort in selling to your trade receivable to your customers, okay, by offering them a longer credit period, you are not able to make enough sales. Okay, that is even worse. Okay, for trade payables, okay, you have increase in the amount of trade payables. Okay, this is not because you are unable to pay. You can see from your cash and cash equivalent you are able to pay, but then you are not paying them. Okay, you are increasing the amounts that you owe to them. Okay, that might adversely affect your relationship with your supplier. They might not be willing to further supply to you, or that they may not offer you a good price. Okay, this is not good. I think if you have cash, you better not trying to treat your suppliers like that. Okay, anyway, okay, the three types of working capital, not good. Okay, how about the fourth type? We look at cash and cash equivalent. Okay, from a glance, okay, it seems that our cash and cash equivalent had improved. Okay, from a very large negative balance 13900 to positive balance. Okay, and there is a great increase, okay, in the cash and cash equivalent, 31,750. Okay, but then if you take a closer look, you will see that most of the increase comes from financing activity. Okay, that is you borrow more money, you issue more capital, okay, to finance your operations, to finance your expansion. You can see in the investing activities. Okay, but then it cannot help you in long run. Okay, because if you are not able to make a profit, okay, and then sooner or later you will be in a more serious financial problem. Okay, so my conclusion is, okay, even though there is an increase in cash and cash equivalent, cash is good. Okay, but then for the usage of working capital, still it is not up to standard. Okay, not good, deteriorated. Okay, so 5 marks. Okay, that would be so. So we have finished. This is our 18th set of paper, April year 2018. Tomorrow we will continue to work on the 19th set of paper for March year 2018.